Welcome to the Collective 2 channel. My name is Roman, and this is the first in a series of interviews with individuals who run trading strategies on the Collective 2 platform. Today's interview is with a strategy developer named James Scheibel, and before we get into the interview, for those of you who are new to the platform, Collective 2 is a modern, innovative, and transparent platform that seeks to replace the entire hedge fund industry. It connects investors with strategy managers, but unlike hedge funds, it offers a much lower cost of entry. And now on to today's interview with James. Hope you enjoy it. We have James today. How you doing?
I'm doing pretty good. Thanks for asking.
Awesome. And I don't know if I introduced myself. My name is Roman. I have some questions for James. He's actually one of our strategy managers at Collective 2. And he's been with Collective 2 for about a year or so, or a year and a half, would you say?
A couple of weeks from 2 years.
Okay, a couple of weeks from 2 years. Awesome. Um, so let's start out with a few questions about sort of your background, where you were, working before you joined Collective 2, and sort of what led you to Collective 2.
All right. So background, I'm a computer programmer. I just to be straightforward with that. I am not a finance manager. I don't do any kind of finances as my day job. I started programming around the time the tech boom was going on, around 1997. I went to college for a few years, left college to go program. So I actually never finished my degree. Um, And then for the next 20 years, I spent my time working on everything from trouble ticket systems to uh, e-commerce, mobile apps, everything in mobile apps from BlackBerry to iPhone, just depended on the time period and what the needs were. And somewhere along the way, I found a real strong interest in data mining, and I've always been interested in stocks. I guess since I was a kid, and the marriage of the two
Mhm.
brought me here. I think I found Collective 2 in a Google search a couple years back, looking for a way to automate the trades I wanted to do, and they have an API, and that's how I came to Collective 2.
Something the viewers would probably be curious to know is whether you've ever applied to work as a quant for larger institutions.
So the short version is I don't know that industry very well. And I actually went to a conference a couple of years ago to get a better idea if that was something I wanted to pursue. And this conference had just a room full of people that was their day job. They were all being paid to be there by their companies. And I guess the short version is they it felt like they were fighting over pennies. I would watch a session, and they'd finish the session and talk about making 3% or 2% or 4%. And in my mind, I'm going, that's not a lot of money. Now, granted, they are managing giant amounts of money, and it's a lot different as the amount of money you're managing goes up,
Mhm.
because you just can't move the market and expect to make
Mhm.
a gain, because then you can never sell when you buy.
Right.
Anyway,
Liquidity issues and yeah.
yeah. So I mean, it there's nothing wrong doing that. It's just that when I saw that, I was like, well, that doesn't feel like something I would be interested in. It doesn't. It felt like you you don't stand out. You don't have a chance to really shine, because you've got 18 people fighting over, should they or should they not short, I don't know, Microsoft, because
Huh.
they think that maybe it's going to move up enough in the next 10 days that they can squeeze out half a cent and still unload all their share, or buy the shares that they need to cover. And it didn't strike me as very interesting. The algorithms that I like to work on are self-automating, and I don't want the constraint of 15 people telling me that, well, we think you're wrong. It's like
Right,
the
right.
algorithm to say it's right or wrong. So where does this go? I looked at at the end of the session. I started talking to some of the people who do work on the behind the scenes of the algorithms that do a lot of the quantitative analysis. And they said, well, you won't be in a room by yourself typing. It would be, it's a regular desk job essentially. If you could get that job, and the job I described to them, where I would pull in data and just try to find a better way to do what they were already doing, it kind of doesn't exist. It doesn't work like that. You might move into that role if you were there long enough, but
Mhm.
essentially the aspect I would enjoy most isn't quite how the financial industry really works. I know that there's a company out there called Jane Street that
Mhm.
does, I think, ETF investment, specifically algorithm driven. And as far as I could tell, they were the closest to anything that would be like a match for me.
Uh-huh.
But I haven't approached them for
Okay.
a job. Also, making money with your own money is much more profitable than making it for somebody else.
Yeah.
I it goes without saying for any job, whether you're uh, running a restaurant or you're, I don't know, a car manufacturer. If you're just working at the plant and you don't own the plant, you're never making as much money as you could. So it makes sense to govern yourself. But I mean, most of us, that's not an opportunity that we can really pursue at first. You need to kind of get there, and I'm finally getting there. And when I saw it, I'd still try it, but it didn't seem encouraging, I guess is the best
Mhm.
way to put it.
Okay. Yeah. I mean, there's definitely more freedom when you're making your own strategy and you're not concerned about having enough liquidity to move like $5 billion in some
Yeah.
security.
I mean,
Um,
those are still concerns, but the
yeah.
concerns are measured by how much money you're dealing with. And since I'm not working with, like you said, $1 billion
Yeah.
fund or $500 billion,
Mhm.
and we've got to get enough diversity in this and small cap and make it work. And you're like, how do you invest $500 billion into all small caps
Yeah.
without just making them large caps? It's like,
Yeah.
and then you try to get out of them and you can't because
Yeah, you
you're
can't.
45% stakeholder in every single company.
Yeah. Hmm.
It's not a good place to be. But on the same note, it is neat. It would be nice to get there, but it's just it's not something I was looking for so much that I was going to start beating on doors. Once I kind of got an idea, the picture, and how it was going to work, I kind of drew back from that and said, this doesn't feel like the right fit for me. I need to have more control and be able to work in the way I want to work.
Right.
So that, like I said, that was at the same time I was working. I've been doing this for about 2 years. About the same time I'd been working on this for 6 months. So I was already starting to see some of the potential results. Some of the 10% gains over 3 months. Now you'll notice that my current fund isn't that old, and it's because I was still figuring out how much volatility there would be and how basically where I could go with it. What were my guidelines? What was going to make
Hmm.
the most sense to do? How diverse I needed to be? What areas I could invest in?
Hmm.
So again, going to that conference really opened my eyes a lot. It's not that I couldn't see myself working as a quant, but they'd probably also want a lot more of a pedigree than I've got in financial industry, because it is an industry. And they're like, well,
Hmm.
you could start out as a junior, quant, and I'd be like, but I've got 20 years, 25 years of computer programming experience. Like, yeah, but you
Well,
have bugger all in our industry.
perhaps, or perhaps they'll see your experience and they'll accelerate you a little bit more. But who
Maybe.
knows?
Exactly. I found myself talking to a professor at the wrap up cocktail party, because that was the person I connected with most at the in the room. And yeah, it was a fun experience. I'll probably go again at some point if if things continue down the path they are. It'll be interesting to see it post pandemic, post 2+ years of looking at all these funds
Hmm.
and having that kind of perspective. Because I certainly went into it with a much more limited experience when I was first there in terms of industry experience. I've been looking at stock and investment for many years, like 15 or so. So
Hmm.
yeah, it's not. I mean, in essence, that aspect of it's not new. It's just a matter of the whole managing a fund aspect.
Hmm. And I'll certainly keep track of your progress. I have your strategy bookmarked, and for the viewers, I'm gonna post James's strategy in the description as well as a link to the Collective Two channel, so you guys can go check it out. Um, so in terms of your strategy, how much of your sort of secret sauce are you willing to divulge, or at least could you give us a basic overview of how your algorithm finds an edge in the market?
Um, yeah. So I mean, it'd be almost impossible for me to give you enough information to reproduce it. So I don't mind divulging as much as as you're willing to take in. Um, the uh, the main aspect, or the main thing I was going for, was to predict the market for a particular stock 120 days in the future, and you want to do that as accurately as possible. So the reason I picked 120 days is to make sure that you're a quarter ahead. Generally speaking, whenever the quarter data hits, that's when all the hoopla happens. It's when the buying or the selling or the nothing. Sometimes it's, status quo, the price doesn't change. But it just seemed obvious to me that those 90-day increments, and I picked 120 days to not only get the lead up to the expected quarterly results, but then also if the quarter's posted late, or there's some other issue, or maybe there's holidays or a catastrophe or whatever, where it's delayed, it doesn't really screw things up. You're looking 100. You're not looking exactly on the day that it's supposed to come out. In essence, you try to build in a little fudge factor, and it really shouldn't matter, because once things have adjusted, there may be other volatilities going into it, but once things have adjusted, you pretty much have your new norm. Now, nobody's going to tell you that, yes, once you've hit the quarter, that's the new price for that quarter. But, there are other things feeding into this as well. There's oil price, there's gold, silver, there's
Hmm.
bond rates. Lots of different daily statistics come in, and it can compare, industry averages and sector averages that stock happens to be in, and see how it compares relative in terms of its price to earnings. And it's not just limited to the like the 200 or so features I feed into it. It can even do ratios between them, and then ratios between the ratios. In essence, I let the machine learning do the machine learning. It is limited in terms of computational power. There's just only so much time in a day before it kind of reaches the okay, market's opening. We need to get some orders out there. But a lot of it, it turns out, is diminishing returns. So you first pass, just as for example, you might pull out a price to earnings ratio as a very dominant trait to use for whether we think the price is going to go up or down. I'm just going to use that as a simple. And then it does another loop to see if it can further refine that. And it says, oh, I'll take my price to earnings ratio and I'll try dividing it by this sounds foolish, but by the price. And like, wait, why would you? That would mean just be 1 over earnings. Like, yeah, it will do that because it's dumb. It doesn't know, but it's not trying just that. It's also trying it against the sector average of price to earnings. So it might be a ratio of the ratios. It's
Yeah.
weird. It's not necessarily intuitive. And some of the answers it would come back, if you were to go through it piecemeal, probably aren't going to make any sense. But it's also making a lot of decisions that probably would. And it's not just one little path. It is a conglomerate of 100 different analyses all stacked together.
Mhm.
And they're all separate in the sense that you do one whole analysis for a stock's value in 120 days, and then you do another one, and you put the two together and you get an average, and you do another one and you get and that's why it is a statistical approach to building a prediction. And it's not always right, but on average, how right it is. So that's probably the last piece of the puzzle, is how do you measure your error? Now, I do not know what they use in the industry. I know I know what they use in data mining, but data mining varies from situation to situation. That's part of the skill of a data scientist, is to figure out what error we should be measuring by. Whether it's log loss or root mean squared error, or some mean average error over some categories or whatever.
Well, all of these
And
different methods, aren't they comparing the actual price at a certain time to the predicted price?
uh-huh.
Okay.
So again, I'm 120 days out. I thought about it, and after fiddling a little bit, you test all the stuff. Nothing's done in the blind one go and it works. I ended up sticking with a percentage change over that time. So if a company goes bankrupt, the percentage change is zero. You would and it's actually minus 100. That's what we
Yeah.
would do, or minus one. And if the price were to stay completely the same, the change would be zero, and then et cetera, et cetera. If it goes up 200%, it's a two. So that's actually how I measure my errors. I do the root mean squared error on a 120-day prediction, and if you take all your stocks and you don't change the price, they're going to be wrong by a certain amount. It's pretty much, in general, it doesn't like vary that much because it's an average of like 8,000 stocks that I'm looking at. And that number, actually, I did some checks to make sure that I had the latest and greatest data here. So if you don't touch any of them and you take the entire set of stocks I'm working with and you look 120 days in the future, 120 days ago and back for a few years, because this is working historically going forward. And then I don't have the data. I don't have today's, what's the result for today at 120 days? Well, I'll let you know in 120 days. But 28.9% change in price on average, up or down. And that's the root mean squared. It's basically it's one standard deviation.
Yeah.
So in essence, what is it? It's like 68% of the time, I think, is one standard deviation. I'd have to double check that. But 68% of the time, that's how
one
much
standard deviation or less.
Yeah, it's 20.9% variation from its original price. So your dollar stock will either be $1.28.9 or it will be what 60. I don't know. It'd be. I'm thinking about it. It doesn't come to mind right. 62, 61% or 61 cents, I guess. So somewhere between there and there, 68% of the time. It's a long way to go. Now, that's if you don't touch anything. It's like, all right, I just want to say it's going to be the same price from today as it is going to be in 120 days, or however you want to word that. Basically, it doesn't change for 120 days. So that's my litmus. That's like the baseline. Like, okay, if I don't do anything, if I don't make a prediction, and I just say it's not going to change, how wrong am I going to be? Well, you're going to be off by that much. So I want to minimize that as much as possible. I want to reduce that 28.9 down to zero if I can. And that's not saying that I'm going to know the price is always going to go up. I'm not picking winners here yet. At this point, I'm just trying to pick accuracy. And then so you try different algorithms. I already talked about layering all these different results and getting an average. Anybody who does data science is going to know all about this stuff. This is not new developments in that regard. My particular algorithm is not like cookie cutter. I don't do tool sets. I use my own code. I've written my own stuff. So you're not going to find what I've got by going to Python's toolkits and trying to conglomerate.
Okay.
You might get something similar, but it's going to be a different flavor in the end. It's just not going to work quite the same.
Do you use Python to write that code from scratch, or?
I write it all in C#.
Okay.
C#, and I use I use SQL Server as a backend. So every day when the market's closed and all my data is available out on Quandl, which is I'm just gonna shameless plug. I'm sure they appreciate it. They are an amazing data source for data to look at. All the data is coming from these companies that scrub their data and make it very clean, because you got to have perfect data or it's garbage in.
And I don't think you're affiliated with Quandl. You just
no.
Okay.
It was their conference, but that's
cool.
They don't pay me. I wish they did, but no, they take my money for the data. It's not like everybody uses Amazon Prime. It's the same thing. I'm not endorsing them. I'm just saying. Well, I am actually, but yeah, I'm not affiliated with them in any way other than using their data that they're selling. And they're a reseller. They don't actually do the data processing. Other companies come to them and then they sell it to you. But anyway, the point is, at the end of the day, the stocks are done. The market's closed, and about 6 hours later, the data is all available for pulling. Some of it's available way sooner, but I wait till essentially every single piece of data I'm going to use is available, and then I start my processing. And
Mm-hmm.
so every night, machine fires up and gets busy collecting data. Then it sends it all to the database. It crunches the numbers. It takes the raw data and moves it into a form that my program's familiar with, and then around 3 in the morning, it starts building the models for the next day. And it takes in all corrections for quarterly filings. It takes in, like I said, commodity prices, global prices. And some days, the market's not open. It still fires, it looks to see, and then it moves on. Yeah, so that's how it's done. Now, I guess the big question is well, how small have you gotten that error down, right? I mean, if it's 28.9% error, if you say it's gonna be the same price in a month or in 120 days, can you get it? And the answer is I was looking at that last night just to be 100% clear. So I got it down to there's two pieces of data out there, and it's worth saying this. One piece of data is the normal SEC filings, all your daily stock prices, the indices, anything that you would normally consider quant fiscal data. That one I get down to about 22.5%. So, I mean, that seems like you're only bringing down the number 6.5%. Yeah, but that's all profit. That's somebody who bought Microsoft is like, oh, it's still at $15 a share 120 days later. I'm not surprised. I'm like, well, you kind of should be, and then I could say with some level of accuracy that, well, no, it's going to be up this much or down this much, and I'll be more accurate than the even money bet, that it's going to be the same.
That's awesome.
Yeah, that's the first piece, and then there's a second piece of data, the one that I'm specifically waiting till 10 o'clock at night to make sure I get, and that brings it down to 17.9%. So almost another 5.5%. Yeah, I mean no, is that right? No, 4.5%. Sorry, I'm just looking at the number. It should be a 5. 22 minus 17. Anyway, yeah, 4.5%. So that now suddenly we're getting pretty good. Now I said in the description for was it data mining AI 2B, the one that I currently got out there, that I focus on specific sectors because there are sectors that it's better at predicting than others, and I guess that just makes sense. There's going to be certain sectors that are much more. There's a hurricane coming in. I think I've talked about reinsurance and stuff before. Maybe not today, but sorry about that. So like for insurance companies, you have the odds of some bad catastrophe happening. And yeah, it's figured into the market. People are guessing that, there's a 30% chance an earthquake's going to hit San Francisco and any given period of 5 years, maybe. And I'm making that up. I don't know if that's true or not. But they're assuming there's going to be some losses there, and they're also assuming they're going to take in enough revenue, and everyone's doing everything they can to make money. But when that actually happens, the price is going to go down. That's just all there is to it. So that might be in a sector that I don't look at because it increases the chance that I'm going to be wrong. I need that high predictability. And once I've got it, then I look at so I've got these predictions. What's got the highest price movement up in the next 120 days? And that's how I pick the stocks. Now, with that improvement, so I mentioned 22.49. Excuse me. It drops down to 20.2 once I start selecting sectors that I'm better at. And once I put in that other data I mentioned, it drops down to 14.4, which is basically half of the error that you would have guessed if you guessed even money. So it starts to become really good. Now that's still a far cry from zero. I mean, zero though would be having the crystal ball and going, oh, it's.
I mean, that's essentially twice as good as a random guess on average.
Yeah. It's one way you could look at it. Phrasing this is very hard because it is statistics, and it's all this is root mean squared error. So
yeah, I'll sort of make an attempt at it. So by root mean squared error, sort of a more common way of referring to that would be just a sample standard deviation.
Yeah.
So what James is saying is his system is able to improve an average guess, just like a random guess, by about double. So if your average random guess is within one standard deviation, he's able to get his guess would be half of a standard deviation.
Kind of.
Kind of.
It's more like, yeah, I flatten the curve so that even if you're one standard deviation
Yeah,
out,
your
you're
standard
twice as
deviation is
good.
is now different from what it
Yeah,
would otherwise be. So you're reducing your standard deviation.
yeah.
Your
It's just
model has a smaller standard deviation size.
yeah. Now there's a
Yeah.
huge caveat to all of this. This is all historical data.
Yes.
So, if somebody asks me, well, what would it have done on Black Friday? I have
We don't
no
know.
idea. See, part of this whole strategy is not to have day trading. It's not to have, it's basically to take the long view and to believe it, not go, I think I know better and start canceling orders or adding orders. And if the market swings down 777 points in a day, or it goes up that day, you don't go in there and start putting in orders to cancel, because essentially it's built into the model. It's looked at data that where bad things have happened. Well, how far back have I gone? I mean, I had data back to 2000 and started using that at first, and then I've kind of brought that up to about 2008, which is into the mortgage crisis. And the reason I don't go back even further, there's a relevance. And you could argue that, well, certain things are always relevant. Yeah, but not sure I can always tell when that is. I try to keep the window at least somewhat reasonable. Also, that other data I mentioned that improves the predictions a step further only goes back 7 years. So once I get outside that window, it stops being as accurate. I can only use the first number. So you can kind of guess what the second number is going to be, but it's not a one-to-one. It's not like one comes down 1 point, the other one goes another point. And it's not even proportional, so a lot of it is just situational. And I mean, is it going to get caught with his pants down? I don't want to say no, but I don't want to say yes either. You do the best you can. It's kind of you hedge, but it doesn't really hedge. It makes the best predictions you can make with the data I've been given, and here we are, I guess.
So you had mentioned a lot of variables, dozens, if not like 100,
A million.
that your system analyzes. What would you say are sort of like the two or three most influential variables when it comes to predicting price? You had mentioned like lending rates.
Um,
Um,
See, I
or does
would.
your system just sort of give you answers and it doesn't really tell you which ones are the most influential?
I can turn on a mechanism that tells me the feature importance, but the funny thing about data mining is a lot of the information that you get out of a particular feature is also contained in other features. So if you get rid of one, the other ones kind of pick up the slack.
Right,
So well, it's really hard to say. And quite
right.
honestly, last time I looked at it, it's been well over a year. So many features are used about as often as the rest of them that it basically, because it's selecting a lot of those features randomly for each step so that it gets a nice mix of one feature versus another. So you're not always investing in price to earnings. So you're not always investing in liability. So you're not always investing in, book value. No, sometimes you're by random chance only giving it oil price and industry average. And it's like, but
Wow.
that has nothing to do with the price of the stock. Yeah, but those are the two you were randomly given.
Yeah.
Do the best you can, and it will make a best guess based on what it needs to, because it's
Mhm.
the training set has a set of solutions, and it's trying to look at, okay, so if I only have these two stats and my data over here needs to go to the left side of the tree and this needs to go to the right, where's the best split? And that's what it ends up doing. It makes that split to move half the data one side and half the data the other. And you might go, well, that's just, in a way it's nonsense because you don't take the price into account or anything. But it isn't in terms of a general picture of if your stock is valued here, um, and the industry is like it is in this particular state, how does the price move? and I say industry, it could be, could be any number of things. It could be a 13-week moving volume that you send in. It's meant to be deliberately random, but then it correlates those to the values that you're trying to predict, and it judges them based on the metric that you're trying to evaluate by, and it picks the best ones out of its random selection, and then it uses them, and then you wash, rinse, repeat, and then again you marry that with a whole bunch of other versions, and you get a statistical average. And it's very hard to figure out exactly what's going on. You see a particular feature used 200,000 times, and you go, well, why was it used 200,000 times? And like, do you really want to try to print out the model and figure that out? And that's just 1 out of 200, right?
Yeah.
So, and you can run it as many times as you want. The more you run it, though, you don't overfit, but you get you kind of get to a point where you're bringing up the noise level. You're losing the signal in some of the static, but at some point, basically, there's no more gains to be made. That's what I'm trying to say. And finding that sweet spot is kind of important, so that you're not running all the way up to 9 a.m. before market opens up. You want to finish before, you want to get those orders in. That being said, if something were to happen where I couldn't finish because power went out and couldn't, or there was a software issue, or the data wasn't available on Quandle, or what, maybe APIs or the connection to the Collective 2 went down. I don't know. Stuff happens. It's not a big deal because it's a 120-day prediction. So you can rest assured that, or you can put the orders in midday. It's not like anything's changed. And you might very well go, well, wait a minute, what happens if the price went up and you wanted to buy? Well, I don't do market buys. I do limit buys, so that you don't ever get caught there. And right. If anything, if the price goes down, you go, well, isn't there new information that's important? Yeah, but it's no different than it would have been at 8 o'clock in the morning, because I still would have put the order in. And you're like, well, hold on. In essence, you don't know what it's thinking. It may very well have expected the price to go down, but in 120 days, the net movement is up.
Yeah, and you get a better price.
Yeah. And in fact, if anything, you make more money.
You make more money. Yep.
Happy chance. Happy happenstance. But yeah, you just don't know. So I have had a couple of times where I put in orders, like at least once, where I put it in at like 2 o'clock in the afternoon, and the market's like almost closed. I'm like, I'm still gonna run it. I want my my orders in. I want these things to be filled, and it's made me money. But that's not the goal. The goal is to put them in solidly at say 6:30 in the morning, 7:30 in the morning, somewhere between there and then, so that there's ample time for everything, all the orders to be in place and no issues. So yeah.
Cool. So one question I wanted to get to was whether or not you have read any books that either inspired you to invest or helped you in your career. They don't necessarily have to be investment related. It's just something most of these types of interviews, I find this question gets asked.
No, that's fair. I have literally within arm's reach a number of different books and papers and things that I can reference.
And your background obviously is in programming, so you had to have learned a lot about the finance industry, a lot about fundamental analysis, sort of on your own. So perhaps there's
probably the single best book I've used ever for data mining is this one. And I say this one because I actually have to read the name, because to me it's the yellow book I grab, the tan book.
Okay.
But it has all the basics of data mining and statistical regression. It covers just about anything you'd want to know. Maybe not as in depth as you want, but it's like a great primer for everything. So 9 years ago, I started using Kaggle as a place to compete in data science and really enjoy just taking part in those. It was a lot of fun. Now, they've moved away from a platform that I can compete readily in. They've kind of stopped letting you submit answers on code you've written. They want you to use Python and run it in place. So these days, I don't really compete much anymore. It's not because I don't want to. It's because they've just changed the way the mechanism works, and I don't have an interest in learning Python and using their toolkits. In fact, for me, the interesting part has always been working on the algorithms. So back though 9 years ago when I first started, I had I say first started, I had worked on the Netflix contest. It was this like 12 years ago now. And there I was really, shooting from the hip. I didn't know what I was doing. I was trying my best to figure out a way and learning along the way what works best to make predictive recommendations for movies. When we get a little further along and I'm start seeing these competitions come up all the time, you start talking in the communities, you start learning what's good. You start reading and you start seeing these different, books out there that they use at university, and buy a few and start reading them. You read them in the sense that you page them, find what you're looking for, read that area, and then you come back and reread it like 30 more times to try to get it. So I know that's not what you're asking. You're asking about finance books and stuff, and I'm giving you data science books because there aren't a lot of finance books. Most of the stuff I've learned over time by reading weblogs, by reading, talking to friends. I know I bought the book by Better Investing by Warren Buffett, and I started to read through it, but it's not that interesting. I'm sure there are college courses like you need to read, this is the first thing you should read, and I don't disagree, but a lot of my experience has been when I'm going to go back in time a little bit further. So I went 9 years ago for the Kaggle stuff, and then 12 years ago, or maybe it was like 11 years ago for the Netflix stuff. If you want to go back to the roots of my real interest in stock investment, it comes from this article from Forbes magazine. I think let's see if I got a date on here. August 1st, 1977 in Forbes. Benjamin Graham's Last Will and Testament. Anyway, it's an article on him, as Benjamin Graham, getting with a computer scientist and figuring out 10 rules of investing that maybe Benjamin Graham didn't put to paper until he was pressed to, because he didn't really work it that way. It's one of the things that he would sit down and do, but it wasn't done deliberately. It wasn't like making a spreadsheet with the columns and all this. At least that's not the picture he draws in here, or at least the author doesn't. Anyway, so I was approached with this document from a friend of mine. Again, we're talking like 15 years ago. Yeah, maybe 16. He knew my interest in problem solving and just general algorithm development. And he's like, I would love to do some genetic algorithms on top of this, where we take the various features that he's got and we try to improve on them by letting a program just churn on it and make it better, make it more accurate to today's world. Because that was written in 1977, and presumably the stuff that he was doing was new in the 50s. Not, by 1977, even then, price to earnings ratio, I'm thinking by then it was probably known. And that's one of the things he's known for, is figuring out that that's a great way to measure a company's value. Mm-hmm. So we did our best, but our best wasn't very good. We didn't have good sources of data then. I was going into Yahoo Finance, which actually was a thing even back then, and grabbing data off their website and putting it into a database so that we could process it. And I say it wasn't very good because if there was a parsing error, you get garbage, and you need it to be perfect. You need as good data as possible, because a lot of the data isn't perfect anyway. But even if you get perfect data and you do your best, you may not do a good job. So in essence, you're trying to get rid of all the errors you possibly could have. And where does this go? So you asked me where I got all my fiscal knowledge. Well, when you spend a year trying to put together a site, a program that will grab data from a website, you start reading everything you can on what you're actually grabbing. What is book value? What is total liabilities? How does that differ from debt? And that's the kind of thing. That's where I learned. I learned by hand, grabbing this data and then reading through just this document, going, okay, so he wants to take a 30-year treasury note. We can't get that. They don't sell those anymore, or stuff like that. And what's the closest equivalent? So you find the 20-year or the 15 or the 10, or maybe you can only get the 10. And you're like, all right, well, we only get the 10. We can't get the 30 because they're just not putting it on the website. And so I can't. And this is how all this started. 16 years ago. And so you kind of get thrown in the deep end of the pool, and you're going to sink because the data you're getting is poor and you don't have all the things you want. And even if you did, even in 2004, 2003, there were already companies out there doing this stuff, and you're behind the curve, and they've got millions of dollars, and they're paying people Morningstar's giving them the data, and you're like, that's not fair. Well, no, it's not fair, but you do the best you can. Now skip to today, where I can go to Quandl, and I know I've already talked about them, but and go, I'd like to buy that data, and then they provide it for you, and all of a sudden, it's magical, because now I've got a wonderful set of streamlined, perfect, clean. I say perfect. It's never perfect. It's as good as they can make it, though. And then they make corrections, and I take in the corrections and I make them when they have them. But it's really good data. It's everything you need. And so that's how I kind of came to be. That's where I started, and going backwards from now to there. Then you come forward, and every time you see some new financial statement, if you see a term you're not familiar with, you click on it and you start reading, and it sounds ridiculous to even say this, but Investopedia is your friend.
Right.
Yeah,
so great resource.
Yeah, that's how I kind of got involved in everything. Now, the worst part about all this is it almost doesn't matter now. The computer does it all. I don't need to know book value. I don't need to know, debt, liabilities, earnings, price to earnings ratio. Now, I do, in the sense that I add some features to the data set where I will compile averages over an industry, over a sector, or a moving average for so many days. And it's good to know which features it's kind of
applicable to.
Yeah. But beyond a few of them, like you asked what are the important ones. I mean, like I make an average price for a couple of days. Price is very important if price is what you're trying to predict. Yeah. And I do that for price to earnings as well, I think. But I couldn't tell you what the other ones are because I don't remember. 3 or 4 others. The rest of it, the algorithm does the work. At one point, I was trying to cherry pick out specific features I knew were important from prior experience. But eventually, I'm like, you know what?
Trust the algorithm.
Yeah, let it do it. And if you've done your algorithm right, or if your algorithm's good enough, it can figure out which ones to use on its own. Mm-hmm. You don't want to send in 4,000 meaningless features. If you put in random noise in there, it will try to use the random noise. So they need to be grounded in reality. And yeah, believe me, there was actually a Kaggle contest, guess the prediction from random noise. They were just trying to prove that there was a winner, and they did a better job, but it was random noise. You can find a signal in anything if you look at history, and if you get lucky in guessing. That's not what we're going for here. That's why you need to make sure that the data provides actual meaningful data. But beyond that, as long as it has true intrinsic value, it should do the rest for you.
Awesome.
I hope that was a good answer.
That was a great answer.
I kind of went all over the place there.
Awesome. So I think that just about does it for our time today. Did you have any sort of last minute things or anything you really wanted to say that you didn't get to?
Nothing comes to mind. Maybe this. I do govern 3 funds, and the other 2 funds are private, and that's because at this time I'm still testing them. I want to see how they perform in a real world scenario before I open it to the public. Yeah. It's a bit unfair to open up a new fund
that hasn't been fully tested enough. Yeah.
Well, and then if you open it up, it's got a 40% gain. People get probably like, "Oh, I wanted to invest in that when it was at 0," but you didn't. Yeah, you wanted to wait till it had the 40% gain, and I'm sure that it's been working well for several months.
Yeah, that is a really good point.
The 2 I'm currently working on are basically more greedy. That's the best way to put it. When I see that I'm not fully invested, it's because I've got a very diverse portfolio going. I've got 45 potential slots that you could have a stock in, and there isn't always a good buy. So why don't you make that list 30? And in that document I showed you, the Benjamin Graham one, he recommended 30. I have a computer and I can do things through automation, so more is definitely possible. But if there are only 30 on average, then let's try to take advantage of that. So I actually made the other two are actually more greedy in that respect, where they're investing more money, same initial amount, but more money in the sense that there's only 30 spots instead of 45 in the portfolio. And then one of them's even greedier still, where it's like, instead of dealing with the sectors I'm better at, it deals with just even the top part of that. So it's, you start, but when you start
Okay.
limiting your world, you start getting less diverse, and so you're more susceptible to the earthquake. And
Okay.
you really want to test this stuff instead of just going, hey, look, this one might do better. And that's the other thing, it might not. The numbers improve steadily as you start reducing the size of your target, but you're also losing the diversity that you need to be able to not only weather a storm, but take advantage of, oh, hey, look, metals, rare earth metals are going up, but that sector by chance isn't in the 1/3 category. It's only in the 1/2, the top half. And you're like, oh, that's a shame. We could have made some money. Oh yeah, it is a shame. But on the same note, the third that it remains, you're going to do a much better job of exactly picking what the target price is going to be, and knowing that what you're buying is going to be a 10% gain in 120 days, which is fantastic, right? Because it'll spike before then, and then you get out and you do something else with that money. So yeah, the other two funds I'm working on, and whenever I feel like, basically when they pass the one that's out there, I will probably open them up. I also, the other funds, you play games with how low of a price, how much market capitalization you want to deal with, because if you're dealing with $5 billion, you don't want to buy stocks that are lightly traded with just no market capitalization. You move the market when you buy into them. So at some point I'll have to stop subscribers on the main one, and these other ones are more geared for even larger investments. So they may not work too. It's worth throwing that out there. I spent a year and a half before I really kind of got all my ducks in order, and it may take another year and a half to get these other two funds to be where I want them to be before they're meritable enough to use for investing. And maybe my bar is a little high. But I want to have something that I don't have to watch day to day. It can just run and make money.
Mm-hmm.
I think that's the dream.
That's the ideal, yeah.
The holy
That's what we
grail,
all
right?
want, yeah.
Let it just run, and turn on the computer and say, how much money did we make today? And that's something, that's probably one thing I'd want to throw out there.
Cool. All right, thanks so much for all that valuable information. And once again, we have James's C2 strategy in the description down below. And I expect that we will have future interviews with other strategy managers at C2. So we will see everybody in the next video. Take care.
Thanks for having me.
Yep.